Investors in 2026 face a unique challenge: how to grow wealth safely while earning strong dividends. The global economic landscape, marked by lingering inflationary pressures and geopolitical shifts, demands a more discerning approach to portfolio construction. In this video, we reveal the top 10 ETFs and stocks with high dividend yields and low risk, carefully selected for stability, growth, and consistent payouts. If you want your money to work harder without sleepless nights, this is your ultimate guide. We will dissect each investment, providing a robust analysis of its strengths, potential risks, and its specific role within a well-diversified portfolio designed for the complexities of 2026. Remember, this video is for educational purposes only and does not constitute financial advice. The content presented reflects our analysis based on publicly available information and historical data. Investing involves risk, including the potential loss of principal, and past performance does not guarantee future results. The financial markets are dynamic, and the specific investments discussed may not be suitable for every individual's financial situation or risk tolerance. Always consult a licensed financial advisor or a qualified professional who can assess your personal circumstances before making any investment decisions. Dividend investing basics. Dividends represent a fundamental pillar of total return investing. They are cash distributions that a company pays out to its shareholders, typically from its profits or reserves. For investors, this provides a steady and predictable stream of income, which can be particularly valuable during periods of market volatility. Unlike capital gains, which depend on the fluctuating price of a stock, dividends offer a tangible return on investment, reducing the sole reliance on stock price appreciation for portfolio growth. In the context of 2026, where economic uncertainty may temper aggressive growth expectations, a strategy centered on dividend investing offers a defensive yet potent method for wealth accumulation. It forces a focus on mature, profitable companies with disciplined capital allocation, which are often the most resilient during economic downturns. Criteria for selection. Our criteria for selecting the top 10 dividend investments for 2026 were rigorous and multifaceted, designed to balance income generation with capital preservation. We established 3 core pillars for our analysis. First, each security had to offer a compelling dividend yield, which we benchmarked at a minimum of 3%. This ensures that the income generated is substantial enough to make a meaningful impact on an investor's total return. Second, we prioritized low volatility and financial fortitude. This involved a deep dive into balance sheets, examining debt levels, cash flow generation, and profitability metrics to ensure these entities could withstand economic shocks. We favored companies and ETFs with a history of lower price fluctuations compared to the broader market. Finally, we demanded a proven track record of consistent dividend payouts and a strategic position within a resilient economic sector. This focus on consistency and sector strength is crucial for ensuring that the dividend is not just high, but also sustainable over the long term. Pick number 10, Vanguard High Dividend Yield ETF VYM. Our countdown begins with pick number 10, the Vanguard High Dividend Yield ETF, ticker symbol VYM. This fund is an excellent cornerstone for any dividend-focused portfolio, especially for those who prioritize diversification and low costs. VYM tracks the FTSE High Dividend Yield Index, which includes U.S. companies that are characterized by their above-average dividend yields. As of our latest analysis, its yield hovers around a robust 3.2%. What makes VYM particularly attractive is its broad diversification across hundreds of stocks, mitigating single company risk. Its portfolio spans all major sectors, including financials, healthcare, and consumer staples, providing a balanced exposure to the U.S. economy. Furthermore, its expense ratio is exceptionally low, a hallmark of Vanguard funds, ensuring that more of your returns stay in your pocket. For investors seeking a simple, one-stop solution to capture the essence of high-yield dividend investing, VYM is a perfect starting point. Pick number 9, Johnson & Johnson J&J. At number 9, we have Johnson & Johnson, ticker J&J, a titan in the healthcare sector and a quintessential dividend aristocrat. The term dividend aristocrat is reserved for S&P 500 companies that have increased their dividend for at least 25 consecutive years. J&J has surpassed this benchmark spectacularly with a track record of over 60 years of consecutive dividend increases. This remarkable consistency underscores the company's financial stability and commitment to shareholder returns. J&J currently offers a yield of approximately 3%, backed by a diversified business model that includes pharmaceuticals, medical devices, and consumer health products. This diversification provides a defensive moat as demand for its products remains relatively stable regardless of the economic cycle. With a strong pipeline of innovative drugs and a global presence, J&J represents a low-risk, defensive stock that provides both income and the potential for steady, long-term growth. Pick number 8, Schwab US Dividend Equity ETF SCHD. Coming in at number 8 is another powerhouse in the ETF space, the Schwab US Dividend Equity ETF, known by its ticker SCHD. This fund has garnered a loyal following among discerning dividend investors, and for good reason. SCHD tracks the Dow Jones US Dividend 100 Index, which is composed of high-quality, large-cap US companies with a history of sustainable dividend payments. Its screening methodology is particularly robust, focusing on metrics like cash flow to total debt, return on equity, and 5-year dividend growth rate. This quality-first approach results in a portfolio of fundamentally strong businesses. SCHD boasts a compelling dividend yield of around 3.5% and one of the lowest expense ratios in its category at just 0.06%. Its combination of a strong yield, a focus on high-quality companies, and rock-bottom FEs makes it a top-tier choice for investors seeking a low-risk, high-performance dividend solution. Pick number 7, Procter & Gamble PG. Our 7th pick is Procter & Gamble, or PG, a global leader in the consumer staples sector. This company is the definition of a defensive, recession-proof investment. Its portfolio includes iconic brands like Tide, Pampers, and Gillette products that consumers purchase regularly, regardless of the economic climate. This consistent demand translates into predictable revenue and robust cash flows, which in turn support its legendary dividend. PG is a dividend king, having increased its dividend for an astounding 65+ consecutive years. While its current yield of approximately 2.8% is just shy of our 3% threshold, its unparalleled history of dividend growth and its defensive nature earn it a firm spot on our list. For investors who prioritize safety and reliable dividend growth over a high starting yield, PG is an essential holding that provides stability and peace of mind. Pick number 6, iShares Select Dividend ETF DVY. At the number 6 spot, we have the iShares Select Dividend ETF, ticker DVY. This ETF offers a distinct strategy by investing in a diversified basket of about 100 high-yielding U.S. companies. DVY tracks the Dow Jones US Select Dividend Index, which selects companies based on their dividend per share, dividend payout ratio, and a 5-year history of dividend payments. One of its key differentiators is its significant allocation to mid-cap value stocks and its heavy weighting in sectors like utilities, financials, and industrials. This provides a different flavor of exposure compared to other large-cap focused dividend ETFs. With a yield that often trends around 4%, DVY is an excellent choice for investors seeking a higher income stream while still benefiting from the diversification that an ETF provides. Pick number 5, Realty Income REIT. Breaking into our top 5 is Realty Income, a unique real estate investment trust REIT that trades under the ticker symbol O. This company has branded itself as the monthly dividend company, and it lives up to the name by paying dividends to its shareholders every month instead of quarterly. This feature is highly attractive for investors seeking more frequent income to cover living expenses or for systematic reinvestment. Realty Income currently boasts a yield of approximately 5%, one of the highest on our list. Its business model is built on owning a diversified portfolio of over 15,000 commercial properties, which are leased to reliable, recession-resistant tenants like convenience stores, pharmacies, and dollar stores. This focus on essential retail provides a stable and predictable revenue stream, making it a powerful engine for generating consistent monthly income. Pick number 4, Coca-Cola KO. At number 4, we find another global icon, the Coca-Cola Company, ticker KO. Much like Procter & Gamble, Coca-Cola is a dividend king with an incredible track record of over 60 years of consecutive dividend increases. The company's strength lies in its unparalleled brand recognition and its vast global distribution network. This powerful combination creates a formidable economic moat, allowing KO to generate massive and consistent cash flows. The current dividend yield is around 3%, supported by the company's strategic focus on innovation in beverages and its unwavering brand loyalty across the globe. For an investor, holding KO is like owning a piece of a global cash-generating machine, making it a reliable and defensive cornerstone for any income-oriented portfolio. Pick number 3, SBDR S&P Dividend ETFs SDY. Our third place pick is the SBDR S&P Dividend ETF, ticker SDY. This ETF is specifically designed to provide exposure to the dividend aristocrats within the broader S&P 1500 Composite Index. Its underlying index, the S&P High Yield Dividend Aristocrats Index, has a strict requirement. It only includes companies that have consistently increased their total dividend per share every year for at least 20 consecutive years. This stringent criterion ensures that the portfolio is composed of high-quality, financially disciplined companies with a proven commitment to shareholder returns. SDY offers a yield of approximately 3.2% and is well diversified across various sectors, though it often has a significant weighting in financials, utilities, and industrials. For investors who believe that a history of dividend growth is the best indicator of future reliability, SDY is an outstanding choice. Pick number 2, ExxonMobil XOM. In the runner-up position at number 2 is the energy supermajor, ExxonMobil, ticker XOM. In an era of energy transition, a company like XOM provides a crucial, if sometimes controversial, role in a diversified dividend portfolio. The global demand for energy remains robust, and ExxonMobil's integrated business model, spanning exploration, production, and refining, allows it to generate substantial cash flows across different commodity price environments. The company has a long history of rewarding shareholders and currently offers an attractive dividend yield of around 4%, while investments in the energy sector carry a moderate level of risk tied to commodity price volatility and regulatory changes. XOM's scale, operational efficiency, and disciplined capital allocation make it a consistent and powerful dividend payer suitable for investors with a moderate risk tolerance. Pick number 1, iShares Core High Dividend ETF HDV. Finally, our number 1 pick for the top safe dividend investment for 2026 is the iShares Core High Dividend ETF with the ticker symbol HDV. This ETF earns the top spot due to its exceptional combination of high yield, low risk, and a focus on financial health. HDV tracks the Morningstar Dividend Yield Focus Index, which screens for high-quality U.S. companies that not only pay attractive dividends, but also have strong financial fundamentals and the capacity to sustain those payouts. The index methodology specifically looks for companies with a strong economic moat and low financial leverage. This results in a portfolio heavily weighted in defensive sectors like healthcare, consumer staples, and energy. With a dividend yield of approximately 3.8% and a low expense ratio, HDV provides a robust, diversified, and risk-conscious approach to generating high dividend income, making it our ideal choice for long-term investors navigating the landscape of 2026. In summary, we've covered the top 10 dividend ETFs and stocks for 2026, from broad market ETFs like VYM and SCHD to dividend stalwarts like Johnson & Johnson and Coca-Cola. As you construct your portfolio, remember the core principles we discussed. Focus on a balance of attractive yield, manageable risk, and a history of consistency. The key to successful dividend investing is not just chasing the highest yield, but building a diversified portfolio of high-quality assets that can deliver reliable income through all market cycles. Subscribe to McCruage Dominion for more insights and let your money work smarter.